Hello everybody, I'm Terry Ryder, founder of hotspotting.com.au, and this is my regular good news bulletin touching on issues relating to the economy and real estate against the backdrop of the virus shutdown. And this broadcast comes on a day in which there were just 6 new cases of coronavirus across Australia. Thankfully, no deaths from the virus. Some states began to lift restrictions and almost 2 million people downloaded the tracing app in the first 24 hours after its launch. Now, there's been a lot of discussion about real estate prices and the potential hit that a few people are predicting it should take. In fact, if the speculation that was rife in media a month ago was accurate, we should have been seeing strong evidence of a decline in property values by now, but we haven't. A report published by CoreLogic has found that 3/4 of the way through April, national housing values are yet to take a major hit, despite the economic fallout of COVID-19 and the restrictions placed on the real estate market. Now, Liza Owen, head of Research Australia at CoreLogic, has noted that the Australian housing market has remained what she calls relatively resilient amid the COVID-19 crisis, despite low consumer sentiment and bans on public auctions and open houses. In the 28 days to 21 April, national housing values across the combined capital cities have increased by 0.4%. CoreLogic noted that this is a slower rate of growth than was recorded halfway through March, but was pleasantly surprised by the positive result. My view is that any level of growth in the current circumstances is remarkable and shows the resilience of real estate in the face of the economic crisis, which we have seen in the past and we're now seeing again. Those figures by CoreLogic, by the way, are similar to those published in the middle of the week by SQM Research, which found a monthly rise in capital city prices of 0.5%. Again, a small rise, but any rise right now is significant. Now, we've seen some forecasts in recent days from St. George Bank, which says that COVID-19 is creating havoc on the economy, but its impact on property prices is expected to be short-lived. St. George Bank has released a preliminary forecast of property price movements, projecting a fall in values this year. Generally speaking, economists always speak in generalizations without accounting for regional differences, and then followed by rises in 2021. The bank has projected roughly a 7% decline in what it calls national housing values this calendar year due to the weaker economy, job losses, social distancing restrictions such as bans on public inspections and on-site auctions. But it says any decline in prices will be followed by moderate rises in 2021. Now, some of the people making predictions about the likely outcome with property prices have little credibility because of their poor track record in forecasting, such as Shane Oliver from AMP Capital. But someone with a good track record of making predictions about property prices is Christopher Joy of Coolabah Capital Investments. Now, he forecast strong price growth between 2013 and 2017, which is essentially what we got, although mostly in Sydney and Melbourne and not very much elsewhere. He also predicted in early 2017 a 10% correction in property markets, which is, again, pretty much what happened, but again, primarily in Sydney and Melbourne and not elsewhere. And in the first half of 2019, he forecast a 10% recovery. And he says, I remain confident that this cycle would deliver total capital gains of between 20% and 30%. So, like me, he sees the virus shutdown and its consequences as a temporary setback and that normal transmission will resume soon. Christopher Joy says, I'll repeat what I've said publicly and privately advised the many folks who have inquired about my forecast for the 7 trillion plus residential property market. Home values are unlikely to fall materially, and in my central case will either move sideways or at most fall by up to 5% over the next 6 months, followed by a robust cyclical boom to resume. Elsewhere, strong buyer demand from first-home buyers and upgraders is likely to put a floor on prices, even though the number of sales is dropping in Sydney, according to Domain. It notes that the city's median house price rose 13% in the year ending March 2020, according to the Domain House Price Report, which was released late last week. But in the weeks following, as the shutdown on non-essential services, a temporary ban on public auctions and open houses took hold, the number of homes on the market dropped 12% across the city compared to the same period last year, Domain data shows. St. George, the suburb that is, had the largest drop in listings, with a 31% reduction in the number of properties on the market from March 23 to April 19 compared to the same period last year. The Sutherland region dropped 26% in terms of the number of listings, followed by Parramatta, Liverpool and Fairfield, which all dropped 22%. That's the number of listings. And Domain Senior Research Analyst Nicola Powell says the number of sellers and buyers both reduce in coming weeks. And she says both buyers and sellers are reacting to the same conditions. A pullback in both will keep a floor under prices. For prices to stabilise, we need a pullback in listings, otherwise buyers would be able to take their pick from what's on offer. So with normal auctions banned, we are seeing some vendors and the agents going ahead with online auctions, and some are getting strong results. A 2-bedroom apartment with views of Sydney Harbour has just sold recently at the weekend for over $2 million under the virtual hammer. The Milsons Point residence beat its reserve by $112,000 after 3 parties spent the best part of an hour fighting it out to win the property. Meanwhile, the Ray White Group claims to have had a strong night in Melbourne as 22 registered bidders turned out across 3 online auctions, and all 3 successfully sold under the virtual hammer for a combined value of $2.4 million. The biggest sale on the night came in Burwood East, where a home sold for over $1 million, which was 71,000 over the reserve price. The marketing campaign attracted 13 registered bidders, 6 of whom competed actively on the night, and the vendors were reportedly amazed with the process and no doubt happy with the result. There have also been good sales achieved in the rural property market. Last week I mentioned the sale of an agricultural property near Yass in New South Wales, which achieved a price well above the reserve at an online auction. And now a rural property near Tumut in New South Wales is sold at a price $185,000 over reserve. A selling agent, Ray Piper, says, "I've been in the real estate game for 21 years, and last week has been the second busiest in terms of sales that I've ever had." He says agricultural land is becoming more and more popular despite the restrictions and limited access to the property. Because of that, we still attracted 21 people to private inspections, and over half of them registered to bid. Now, one of the comments I've made in recent weeks is that the shutdown, which has forced people to work from home, is likely to enhance a trend already underway. People moving out of the big cities to the fringes of the metropolitan area or to regional towns and cities. And new research published this week would tend to support that idea. It suggests that outer-ring areas disadvantaged by long commuting times are poised to see renewed demand as employees get a taste of working from home. A survey conducted by social research agency McCrindle and research platform Synth found that 78% of Australians think that working from home will become the new normal. And 76% of those surveyed say that they would stay longer with their employer if they were to be offered more remote or flexible working options. Demographer Mark McCrindle said these experiences could influence how people choose their next home in the future. And I think that some of the people forced to work from home in recent weeks will like the idea and seek to make it a permanent arrangement, which will result in increased demand for real estate in the outer ring areas of our cities and in regional centres. Now, turning to some of the development news happening around the nation, the Victorian State Government has officially approved the $2 billion Southbank by Beulah project. This is a 270,000 square metre mixed-use vertical village, which is forecast to generate 4,700 construction jobs, and then, after completion, another 3,200 ongoing direct jobs to be generated across multiple industries, including office, retail, entertainment, hospitality and childcare. And it would ultimately grow the working population of Southbank by 8%. Meanwhile, the Victorian State Government has set up a task force to identify and recommend commercial projects that can be fast-tracked for approval and commencement. This is a further sign it is counting on private money and projects to stimulate the economy as it seeks to recover from the virus shutdown. Also in Victoria, a new passenger and freight terminal will be built in North Geelong as it becomes the new Victorian home of the Spirit of Tasmania ferry service. Geelong Port is also set to undertake a significant upgrade of its berth at Corio Quay South, with the developments securing the vital freight link across Bass Strait for the long term. The queue in getting the ferry service to relocate from Station Pier in Port Melbourne has been hailed as a great opportunity to grow tourism and other downstream businesses in the Geelong region. Now, every year, more than 450,000 passengers and a huge amount of freight are shipped on the Spirit ferries, with the figure set to grow as the Tasmanian government commissioning 2 larger replacement vessels within the next few years. Looking at some of the other stimulus measures, in South Australia, landlords will get a share of about $50 million in emergency land tax relief over the next few months as part of that state government's package. Treasurer Rob Lucas says small and medium-sized tenants, including gyms, restaurants, cafes, beauty salons and hairdressers, will be some of the biggest beneficiaries of rent relief that will flow from the land tax package. About 10 million will be dedicated to residential landlords, but details around how that will be distributed are still being finalised. The announcement coincides with the pledge from the government to provide rent relief to businesses significantly affected by COVID-19 that operate in state-owned buildings. Now, we're all aware that major banks have been offering mortgage holidays to people impacted negatively by the shutdown period. Although relatively few have moved to take up that offer, only 4 to 5% of mortgage customers, according to the latest report. But banks are also offering relaxed situations for people struggling to pay their credit card debt. Westpac customers affected by COVID-19 will not be charged interest on their debt for 3 months if they need to take a credit card repayment holiday. Research by ratecity.com.au shows that more than a dozen banks are offering credit card repayment pauses as part of their COVID-19 hardship measures for up to 6 months, but will continue to charge interest during this time. Other relief options for credit card customers include moving to a low-rate credit card, lowering their monthly repayments, and moving to instalment plans. Now, for the last word, one of the big issues in all this is not so much the facts that we're dealing with, but the way that mainstream media reports those facts. Very often the headline is extremely misleading. In fact, sometimes the headline is an outright lie because it's all about clickbait. The media wants the headline to inspire you to click through to the article. And when you get there, often you'll find the substance of the story is quite different to the claim in the headline. It's outrageously dishonest in many cases, and they shouldn't be allowed to get away with it, but they do. Now, here's just one example which features Fairfax, which is generally the most sensationally negative of media's publications, notably in the Australian Financial Review newspaper, which sadly has become a tabloid rag. Now, one of the Fairfax publications recently published an article with a headline that said, New South Wales land values dropped by 33% after bushfires, Valuer General finds. So let's be clear, the headline said that New South Wales land values had dropped by 33% after the bushfires, according to the Valuer General. Now, here's what a reasonable reader would conclude from that headline, that following the bushfires last year, land values across New South Wales dropped by a third, according to the New South Wales Valuer General. But in fact, that's not the case at all. The story wasn't even referring to last year's horrific bushfires. They were referring to more historic events, including bushfires that took place in 2013 and 2017. And land values did not commonly fall by 33% at all, despite what the headline said. Here's what the report actually said, in part. New South Wales Valuer General David Parker's report found land values varied depending on where properties were located, how much land was destroyed by bushfires, and the level of demand for land in the area. If there was strong market for land before the bushfire, and the bushfire only affected a small proportion of properties in the area, there was almost no effect at all on land values, Dr. Parker said. The study found an example of this best case scenario in the 2013 Blue Mountains bushfires, where land values dropped by only somewhere between 2 and 6% due to the damage to relatively few properties, but sustained high levels of demand in the region and in turn property prices. But Dr. Parker said that the scenario was flipped, land values suffered more. He said areas where demand is low and high proportions of properties of land was destroyed by bushfires, you saw a bigger impact on values. The study found a drop of land values ranging from 11% to 33% after the 2017 bushfires in the Warrumbungle local government area. So that 33% drop in land values that were shouted in the headline related only to the worst case scenario, one event in 2017, and in most cases the decrease in values was substantially less. So that headline's screaming of a 33% drop in land values across New South Wales was at best highly misleading. And that sadly is the problem with mainstream media day after day. Headlines that lie to you above stories that very often take an unreasonably negative view of the facts, and in some cases disregard the facts altogether, which we've seen recently with the reporting of property prices amid the pandemic, which to date have shown no evidence of decline. Not yet, anyway. That's it for now. Terry Ryder from hotspotting.com.au signing off. Bye for now. Let's talk again soon.